Yeah, good morning in Germany and Europe. Good afternoon in Asia and China. Welcome to our webinar of the Sino-German Center at Frankfurt School of Finance and Management. I'm especially happy to have two high-level experts with me. Mr. Mu from the People's Bank of China, he is from Beijing with us, and here in our studio we have Dr. Jens Reich from German Bundesbank. I will introduce both in a second. Let me say some words to the topic up front. You know, the title is Central Bank Digital Currencies, China and Europe in comparison. And as you know, this is a rather hot topic in a certain sense. China already started in 2018-19 to launch a digital yuan in China. Today, I think we have around 29 cities, including all the big cities, where the digital e-yuan is a legal tender, and in a new move from the beginning of this year on, the digital euro is also allowed to be a deposit with the commercial bank, and deposit means, of course, also paying interest rate. In Europe, in Europe and Germany, the situation is different. We now know that the final decision by the European Parliament about the launch of a digital euro is scheduled for June 23. The ECB, including Bundesbank, already made their proposal at the end of last year. We have here some headwinds in Europe, especially from the private banks, which concern to lost some transaction and payment business. I'm sure Dr. Reich will come to this issue. A final note: this is not only national payments system digital, it's also international. Most of you will know that, for example, the United States is going for a total different approach. Very much, especially President Trump, very much favoring so-called stable coins, a private issue digital currency backed by the US dollar. But this is not a favorite solution either in China nor in Europe. But anyway, without our own digital currency, it's difficult for the respective central banks to have also a say in the international payments, despite the dominance of the US dollar. Having said that, a short note: as always, we have introductory statement. We start in a second with Mr. Mu, and after that, Dr. Reich will give his introductory statement. As you know, we have after that a Q&A session, so feel free to type in your question already during the introductory statement, and I will then forward this question to our respective speakers. Yeah, now I hand over to Mr. Mu. Let me shortly introduce him here. Mr. Mu Changchun is the Director General of the Digital Currency Institute of the People's Bank of China in Beijing, and he joined since 2019. And Mr. Mu already joined the People's Bank of China in 1995 and was appointed as the Deputy Director General of Payment and Settlement Department in 2017. Mr. Mu is also a member of CPMI, a member of the CGFS Working Group on Stablecoins, and also a member of FSB Financial Innovation Network, and a member of IMF High-Level Advisory Group on Finance and Technology, and actually is one of the leading international experts in the field of digital currency, and has published a lot of papers and articles to this topic. So thank you very much, Mr. Mu, for joining us today. The floor is yours. Please go ahead.
Thank you, Professor Halston Loschel. It's a great honor to join today's discussion. Let me start with the theoretical evolution of digital fiat currency. And I would like to share our experience in upgrading the e-CNY from version 1.0 to 2.0. And we have spent years, developing and promoting our digital fiat currency. I hope our practical insights will be useful today. To begin with, money always involved with technology and the economy. We started with barter and later shells become the medium of exchange. As mining technology improved and trade grows, uh, and nations began minting metal coins with standard values. Then came a major leap. Thanks to the printing technology and booming economy, China's Song Dynasty introduced the world's first paper money, and eventually we moved to the modern fiat money. And now we face another massive shift, driven by the internet, mobile payment, and cryptography. Money is moving from physical to digital forms. If we look closely at history, every major shift in money reveals a common theme, the tug of war between officially issued and privately minted money. Take early paper currency. Private merchants first issued notes called jewels in the Song Dynasty, and eventually the state stepped in. The Song Dynasty government unified the system with official jewels. We see the exact same pattern today after 2008 financial crisis. Trust in traditional monetary system dropped. Crypto assets and stablecoins like Bitcoin, Ethereum, Libra, and USDT emerged. Private players use blockchain to issue virtual currencies largely for profit. It's simply the latest chapter in the age-old battle between the private issued money and the official fiat currency. It's just playing out a new technological foundation. And historically, money evolves through a constant interplay between its form and its credit foundation. First, the form changes are always driven by technology and economy. Innovation constantly pushes money to be cheaper, more secure, and highly efficient. Second, the credit foundation. History shows that a continuous tug of war between private money and the sovereign credit. In the end, the fiat currency or fiat system prevailed. This was a natural historical choice. Sovereign credit is fundamentally superior. It's essential for stopping market panics and preventing financial crises. Today, commercial banks' money is starting to look a lot like a central bank money. The boundary between the two is blurring. The convergence is driven by three key factors. First, the credit foundation is stronger than ever, built on reserve requirements and the lender of last resort mechanism. Deposit insurance as a massive layer of sovereign backing. This greatly strengthens trust in the commercial bank money. The second, the liquidity landscape has fundamentally changed. Fintech has made this incredibly easy to convert broad money into narrow money. Thanks to the mobile payments, a consumer can turn savings deposits into highly liquid funds in seconds. There's another key phenomenon we must note. Mobile payments have changed user behaviors. Today, customers can instantly move their deposits from a troubled bank to a safe one. In practice, this rapid mobility actually expands the effective coverage of deposit insurance. Third, the digital technology has transformed our ability to supervise commercial bank money. Under the traditional account system, the central banks relied on the delayed ex post data. Today, digital transformation gave us an end-to-end closed-loop system. We now have real-time tools to precisely manage financial risks and keep the system stable. Because of this, drawing a strict traditional line between the commercial bank liabilities and central bank liabilities simply no longer makes sense. Let's shift to a classic framework for classifying money. Back in 2017, the BIS published a taxonomy that we now call it the money flower. It breaks down different forms of money along four dimensions. Uh, First one, who is the issuer? We look at whether it's a central bank or not. Second, what is the format? We distinguish between digital and physical money. Third, we look at accessibility. Specifically, is it available to the broader general public? The fourth factor is we look at the underlying technology. Is this money token-based or account-based? The token-based means the value is stored directly in the tokens or is still stored in the bank account. Okay, given this, separating money purely by who holds the liability is no longer enough. Because of this, we have upgraded the money flower framework. So we changed the taxonomy a little bit. We shifted the core dimension from direct central bank issued to central bank supported. Under this new framework, the definition of a digital fiat currency is clear. It simply must meet two conditions. First, it must be backed by the central bank mandatory reserve. And second, it must strictly follow the central bank's business rules and technology standards. This dimension is highly flexible and is not limited by token-based or account-based architecture, and is applied equally to both wholesale and retail use cases. So as you see from the slide, all four categories in the middle in this new framework now fall under the scope of e-CNY or digital fiat currency. Since 2014, the e-CNY project has moved through three main phases. Theoretical research, the second one is closed-loop testing, and broader regional pilots. Let's look at a few key milestones. By 2019, the top-level design and core system testing were completed, and we then roll out regional pilots focusing on safety and manage the innovation. In 2022, we launched the official e-CNY app to the public, and the same year, we successfully showcased diverse payment use cases at Beijing Winter Olympics. And during the e-CNY 1.0 phase, the consensus was simple. That is, the e-CNY was strictly digital cash. And for the operating institutions or the business operators, those funds were held off balance sheet. They could not be used for credit creation. But as adoption deepened, this digital cash model began to face new challenges. Let's look at the macro level first. The e-CNY 1.0 works differently from traditional banking. Because it's backed by 100% reserves, it is a direct liability of the central bank. And when users move funds into the digital wallets, that money effectively leaves the commercial circulation. This creates a structural challenges. As the wallet balances grow, more funds are drained from the banking system. This shrinks the credit creation. It lowers the monetary multiplier. And ultimately, it becomes a narrow banking system and exerts a contractionary effect on the real economy. Now let's look at the micro level. We need to boost the commercial engagement. Think about how it works in 1.0 phase. The e-CNY wallets are hosted by commercial banks. Those banks do a lot of the heavy lifting. They secure the customer funds, they provide the payment services, They also bear the burden of the compliance and the AML responsibilities. However, in the e-CNY 1.0 model, the currency remains as a direct liability against the central bank. This creates a clear mismatch between the responsibilities and the rewards. The commercial banks, take on the operational risks, but they don't get the financial benefits. We need to align these incentives. To do this, the ECY must shift from a off-balance sheet item to a on-balance sheet liability for the operators or the commercial banks. This is the only way to build a sustainable incentive mechanism. So in short, we are changing from a CBDC system to a digital fiat currency system. So to meet these practical needs of this new phase, we are upgrading to e-CNY 2.0. This upgrade draws heavily on our pilot experience and the natural evolution of monetary systems. The biggest change is at the retail level. The e-CNY held by the customers is no longer a direct liability against the central bank. Instead, it's now a direct liability of the commercial banks. So in that case, that part of the e-CNY is not CBDC anymore. It's actually a digital fiat currency. We brought e-CNY onto the balance sheet of the operators or the commercial banks. It becomes a on-balance sheet liability against the commercial banks or the operators. It operates under the standard fractional capital reserve framework. The central bank pays interest to the commercial banks as the statutory reserve rate. And in turn, the commercial banks, will pay interest to the users as standard deposit rates because, it has been integrated with the deposit system. This allows the commercial banks to use these funds for asset allocation, ensure that the financial system keeps running smoothly. With this structure, the business operators can confidently engage in lending, credit creation, and interest-bearing activities. So what about the wholesale level? The e-CNY held by the commercial banks, whether in the central bank system or on the mBridge or other central bank and e-CNY systems, it remains a direct liability against the central bank, or the PBC. It is strictly used for inter-institutional fund settlement. For non-bank payment service providers, the rules are different since they lack deposit creation capabilities and they don't have the banking license, so they must continue to provide 100% collateral. To summarize, the e-CNY 2.0 is fully integrated into the commercial bank deposit structure. It forms a true two-tier system, the direct central bank liability at the wholesale level and the indirect central bank liability at the retail level. This model works. It maintains the central bank regulation over the money base, and at the same time, it aligns the incentives. Banks get clear balance sheet benefits, and users earn reasonable returns. And to support these changes, we have also restructured our institutional setup. At the top, we form a e-CNY oversight committee, and we also have a joint office at the PBC DCI. It oversee the entire project. And locally, we established the working groups to link our Shanghai headquarters office with also within the regional branches, ensure the top to bottom alignment. And on the infrastructure side, the PBC DCI now manages two key hubs. The e-CNY Center drives the domestic system operations and build out. And meanwhile, the e-CNY Center International focus on cross-border expansion and offshore use cases. In summary, e-CNY 2.0 is accumulation of 10 years of pilot experience and international best practice. Our objective is clear. We want to solve real world or real economy problems and mitigate financial risks. e-CNY cannot just be a digital payment tool. It must be deeply integrated into the broader financial system. This is how we best serve the real economy, demonstrate and ensure the long-term financial security. Thank you. I will stop here.
Yeah, thank you very much, Mr. Mu, for your excellent overview about the introduction of the e-yuan in China and let's say governance system and also the integration in the commercial banking system. Thank you very much. Again, to the participants, if you already have questions, please type in. I hand over now to Dr. Jens Reich. He is the head of the digital euro ecosystem at Deutsche Bundesbank since summer 2024. He already joined Bundesbank 10 years before and was before Bundesbank from the BaFin here, our regulator, Federal Financial Supervisory Board in Germany. And in the Bundesbank, he had before held positions in the DG Financial Stability Policy Department, in the Research Department, and in the Strategic Policy Group. And already in 2019, he became Deputy Head of the Vice President's Office before get promoted to Deutsche Bundesbank Representative for North America and Head of Deutsche Bundesbank New York office in 2021. So he's also very much involved in the digital euro and in charge at Bundesbank for this task. So Jens, I hand over to you. Please go ahead.
Thank you very much for the invitation. If you wonder what ecosystem means, just 2 words on that. We call the team ecosystem because we're dealing with everything around the digital euro, our retail product. We deal with everything around our wholesale product in terms of market contact, Pontes and Appia, and everything around digital central bank money, which means stable coins and commercial bank money token. My presentation will focus very much on our retail product, but we can go into any other direction. I'm very grateful that we had a very broad and general introduction because mine is very narrow. I skipped that for time reasons. And I assume that we'll have a discussion on where the differences between the Chinese and the European product may be. And that's why I'll start with our motivation, why the Eurozone is discussing the retail product, the payment product, so much. And there are 3 broad pillars on which our decision to promote a digital euro rests. On the left-hand side, it's very much in line with the presentation we've just heard. There's competition between different forms of money, and with the evolution of DLT-based money, the question was like, is there a new competitor in town? And our own product, the only product we offer to the citizens, which is cash, is declining from year to year. And even in cash-loving countries like Germany, people tend to use it less and less. The numbers you see here on the left-hand side of the chart is the change in cash usage from 2019 to 2024. It's a drop in 24%. If you look back, over 80% of transactions in Germany were carried out by cash. Today, we're at roughly 50%. And the question is, so we never worried that the decline in cash, so to say, is going on for decades. We never worried as long as the shift was from public money, cash, to private money in the sense that it was bank money, which was offered through banks, which are regulated, have reserve requirements and so on. But the new competition, the new competitor in town were was money which was outside of the complete banking and financial system. And that's why we asked ourselves, is the product we're offering to the citizen still competitive? Is it still attractive for people to use? And the answer we gave is no. We think we need, besides coins and besides paper notes, we need a third pillar to provide the central bank currency to the public in a digital form, because people like to pay digital more than they did in the past. I think that is something which all the central banks around the globe see and assess similar. The question is, what do you do about it? For the Eurozone, there's a second pillar, which is, I think, quite unique, and you'll not find in the US, and I think you'll not find in China. That is that the Eurozone was formed out of, by now, 21 countries running national payment systems. And you would assume that by creating a monetary union, these payment systems converge. But they didn't. So if you go through the P2P payments, if you go through point-of-sale payments, if you look at how people pay online, you'll see that you have, basically following the national borders to almost 100%, you have systems in these former independent countries, monetary independent countries, which do not breach the national borders. So if you look at card payments, for example, and you look at the Eurozone, there is a market in 5 of them for national card solutions. Only 5 of the 21 countries have national card solutions. Germany, which you'll see in the center of the slide, is one of these 5 countries where we have Girocard, a national card provider. These solutions are national solutions, so if you take your German Girocard, which you can use for point-of-sale payments, and you go to France, it's not working anymore. And out of the 5 countries which are lucky to have one, most of them are only national solutions, but in the remaining of the 21 countries, you do not have European solutions. And that's not only true for card payments, that's also true for P2P payments and the question of how you pay in the internet. And in particular, P2P payments is in particular painful to me, because there we would even have SEPA and SEPA instant transfers, but people actually prefer to pay in different ways. And that's why what you see on the right-hand side evolved. On the right-hand side, you see for the, I have to update the slide, it's only 20 countries if you look precisely. But if you look for the 20 Eurozone countries, who's leading in point-of-sale payments? Who's leading in e-commerce payments? Who's leading in P2P payments? You'll see that it's not the national products that we have. I mean, some countries don't have national products at all, but you'll see that even in countries where you have national solutions, the markets are dominated by the main 3 American players. And that's why in the Eurozone, different to other currency areas, we have an issue where we think the Eurozone as one currency area should have a payment scheme, a European payment scheme, which is run out of Europe and which works all over Europe, all of the Eurozone, and across all payment situations, which means point of sale, e-commerce, and P2P. That's kind of the main line, the 3 pillars of why we think about a retail product. And how is it going to look like? We call it a digital twin of cash. That's very much what was explained before as part of the e-yuan project, which means we offer people that they can get access to a digital version of cash with the properties which you see at the lower part of the chart, free of charge for basic services. It's central bank money, it's accepted throughout the euro area, very high level of privacy, which we can discuss, and it's also functioning offline. How do people get access to this digital form of cash? Well, you have to have a bank, you have to have a payment service provider, which offers you services, and they connect to our systems, and people can get access to the central bank money through their payment service provider. But, so to say, instead of going to an ATM and withdrawing money from your account, you can now download the currency from your account on your phone, if you wish. And you can use that, whether you do hold a balance or not, that's not actually important, for payments in the Eurozone, in a store, in e-commerce, and for sending money around between payments, between people. and for contactless payments, for QR code payments, and if you want to use your email address for online payments, you can do that as well. So we're providing an infrastructure which is provided to the public through their PSP, through their bank, but which gives them access, kind of say, to a safe deposit, also an additional safe deposit in the central bank where they can store the currency or download it on their phone and use it. And when is that going to come? It was mentioned already before. The process is ongoing. The Commission has launched a proposal in 2023. The proposal is discussed. The European Council came up with its own position by the end of 2025. Parliament is going to form a position, hopefully by this summer, which could then lead to starting the trilogue process in the second half of 2026 and hopefully reaching a legal consensus by the end of the year and passing the regulation by the end of the year. If that would happen, we would roll out a pilot in 2027 and then finally introduce it to the public in 2029. That was my short presentation on the retail side.